And thanks for having me here. Yeah, I actually have had some fun in the markets. I've been professionally involved in trading since 1999. What we didn't say was I actually started and ran a high-speed arbitrage hedge fund from 99 up to about 2005. Over a period of time, that transformed into high-frequency market-making strategies, a lot of direct market interaction, and then eventually kind of got to the point where, by the way, that lifestyle will completely burn you out. I got to the point where I wanted to drop out for a while, so spent a little time in the Bahamas, and I lived on a tiny island and walked across the street to the beach and didn't focus on the markets at all. Got sucked back in and ended up managing trading operations for a Chicago-based trading firm. I managed their European trading operations. Got very, very involved in derivatives, options especially, and managed a lot of different trading strategies and mainly focused on European, actually. Figured out that Chicago is cold, and Chicago, after living in the Bahamas for a few years, is really cold. So I moved down to Florida, got out of the blistering cold, a little away from the center of things, but now I manage money, I teach, I do coaching, and I work with T3 Live. Highly recommend you check them out, t3live.com, and great group of people, both options, which I'm working in, and stock trading. Some brilliant guys over there, a lot of fun to work with them. Strongly encourage you to check them out. Now, today I'm going to be presenting a single strategy. Now, I need to give you a little warning here. Normally, I take several hours to go into this, and we don't have that. So I'm going to move through fairly quickly. Bear with me. My goal is to make sure you understand the concepts, know what you're looking at, get enough out of this that you can go down this road a little bit further and really start working this into your own trading strategy, your own trading style. Hopefully, some of the things that I give you will kind of enlighten you about different ways of looking at the options market, and give you some hard and fast, things to look at when you're setting up iron condors. Now, I deal with a lot of different trades. This is just one of them, but iron condors are a meat and potatoes trade for me. I do a lot of them. They're a big part of my actual trading strategies. So this isn't some kind of esoteric, hey, isn't this a cool idea? This is the way I make money. So sharing that with you, and hopefully it's valuable. Now, just a second here. I am having one small problem, Reed. I do not see the chat, so I can't see people's questions.
Do you see on
not sure
your
if
little...
you can help me out with that.
Yeah, on your dashboard right there where it has the webcam and the audio and all that kind of stuff, do you see that?
I see the dashboard. I see the people can hear me, see my screen, all of that stuff, but I don't see the chat box.
Do you see questions?
I see a questions list, yes.
Okay, hit that plus button.
Okay.
And then you'll be able to see all the questions, and you can respond to them that way.
Ah, okay.
And then if you need to push out anything like a link or anything like that, I can just do it for you since you can't see that chat box. But if you want to answer any of the questions, you got that up there. Okay,
sounds good. This is a little different from what I'm used to. I'm used to the chat box as opposed to the question box, but
no worries
we'll
at
just roll with it.
All right.
All right. I'm sure you guys have probably heard this almost every time you've done a presentation, but the lawyers do actually require me to give you a bit of a disclaimer here. So just need to remind everybody that T3 Live, and who I'm representing today, is not an investment advisory service or registered investment advisor or broker-dealer or any of those things. We're here to teach you about ideas behind options trading. Options trading can be risky, and we seriously encourage you to follow along using paper trading account until you know the stuff well. When and if you are interested in doing some live trading, talk to a broker. The live licensed broker can help you a lot in these things, and I want to see you make good decisions and safe decisions. They can give you the advice that we can't. So, like I said, I'm sure you've heard that half a dozen times, but got to appease the lawyers once in a while. All right. first of all, got to go back to super basic concepts on options. And I realize that most of you probably understand most of this stuff. Anybody who's traded options probably has a basic idea of what I'm going to talk about already. I want to start here, though, because understanding where we're coming from is an important thing. And I'm going to build on this because the trade that I'm going to talk about is actually fundamental to how options work. So an option is a contract. It's actually created between two different people. One's the buyer and one's the seller. And the contract says that you have the right to buy or sell a stock at a specific price over a set period of time. So between now and the third Friday of the month, if I buy a call option, I can purchase this stock at this strike price, $35, whatever you want to call it. You pay money for that right. You're paying somebody for the ability to have that option over that period of time. And the seller receives the money. The reason they're receiving that money is they're taking a risk. So keep that in your mind. Everything's created between a transaction between the buyer and seller, and the total number of contracts is the open interest. Calls the right to buy a stock, puts the right to sell a stock. All basic stuff. Now, pricing. Remember I said to remember that the guy who sells the option, and it could be me, it could be you, it could be a professional firm, it could be a floor broker, a wide variety of different people selling options, creating these options in the market. But there's some fundamentals on the pricing of those options. There's two parts to the pricing of any option. There's intrinsic value, and that means that if the stock is currently trading past the option strike price, then there's a certain amount of value that if I executed that option, let's say a stock is trading at $35.60, and I had an option with a strike price of $35, a call option. I get to buy that stock at 35 bucks. I can execute it and instantly turn around, buy it for $35, sell it for $35.60 on the open market. Intrinsic value is that amount of money that's sitting there that I'm going to lock in. It's a built-in profit on it. Well, if somebody's selling you an option, then obviously they have to sell it for more than the intrinsic value. Then there's another little piece to this is called time value. Now this isn't a risk premium. This is just if I were to do all of this, instead of say investing in a risk-free T-bill or something like that, which you're not going to make any money on anyhow, I want to make at least a certain amount of money. So I need to make sure that I get the intrinsic value for the option plus a little bit extra for the time value. Now, here's where we get into the real stuff. And this is where we got to think. This is what's going to inform us a little bit about how to build this specific trade I'm going to talk about here in Condors. So the extra bit, you're never going to get an option sold to you at exactly its intrinsic value, especially if the option is out of the money, which means that there is no intrinsic value. There's always a risk premium built into the option. Now, every seller of options wants to make money. There's nobody in this business that I have ever met, and I don't expect to meet, that does this as a charity. They want to make money, and they want to protect themselves against the risk, because if they sell you an option to buy at 35 and that stock goes up to 38, 39, they're on the line for delivering that stock to you, and they got to go out to the market and buy it. So the risk premium is added to the price of the option based on the seller's analysis of the chance the stock will go past the strike before the expiration of the option, putting them at risk. If the stock is moving around a lot, then the risk is high, and the option price is also high. If the stock doesn't move much, then the option price is going to be lower. Pretty simple. I mean, if you've got a high risk that the stock price is going to move past that strike and go way, way into the money, the guy who sells it is going to pay attention to that. He's going to want more money to sell it to you because he wants to protect himself. Upcoming events such as an earnings announcement, FD announcement, anything like that that increases the risk is going to increase the price of an option. All of this together is generally referred to as implied volatility. It's the price of the option, the price that people are asking for when they sell the option, is implying that there's a certain amount of risk. Now, remember, one of the pieces in this is the fact that everybody wants to make a profit. So the people selling the options are going to try to jack the price up as high as they effectively can while still being able to get somebody to buy it. I mean, they want to get as much as they possibly can. So when they're figuring out the price they're going to sell it, they don't sell options at exactly the price that they believe the risk is at. I mean, what sense would that make? Because on average, if I did that, I would make no profit. So that's something we want to be looking at. Implied volatility can be high or low. And there's a lot of reasons why implied volatility can be off from what the real risk of the stock price movement is. You know, it can be overpriced or underpriced. Option writers may have written too many options and are not interested in selling anymore. They might just jack the price up. If somebody comes to them, they'll take it. If not, they don't care. There may be rumors or vague risks that are driving implied volatility up. You know, any kind of potential risk in the market, option sellers are going to use to price options higher, because at the same time that they're seeing that risk, buyers are seeing that risk, and they're going to try to protect themselves against price movements using options, causing more buying, causing the price to go up. Large hedge funds. Now, these are a real common driver of implied volatility. You've got things called long-short hedge funds. Very big part of the market. Their goal is to create a portfolio of long positions and short positions that makes a little bit less than the overall return of the market. I did say that, less. But they have a significantly lower risk compared to the market. Now, why would they do this? Mainly because they have some customers of theirs, pension funds, very large retirement funds, endowments that want to take extremely low risks, and they're willing to make just a little bit on their money, and they're willing to use these hedge funds, long-short hedge funds, to do that. Well, these guys have an incentive to never lose much, and they buy up options all the time. And when they see things being risky in the market, they buy up a lot of options and drive up the implied volatility on the options. So lots of things moving that implied volatility around. Sometimes options traders just want to reduce their positions, and they will basically take opposite sides, hedging up things, driving prices down. Now, understanding this gives you an edge in the market, and especially when we're talking about an iron condor. Now, for those of you who don't know what an iron condor is, I will be going into all the details of that in just a second. In fact, I've got a spreadsheet that I'm going to hand out that should give you a nice, easy way to analyze these things. This is based on my opinions and theories. Last thing that we should be paying attention to is something called theta erosion. It's time decay. The longer an option has before the expiration, the longer period of time you can hold on to that option and execute that option, the more valuable it is, because there's more chance or more time for the stock to go into the money and you to actually win on the trade. As you get closer and closer to the expiration of the option, there's less reason to charge a lot of money for it risk-wise, because there's less time, and less time means less risk. There's less time for bad things to happen. This means that the price of options goes down fairly quickly and actually starts accelerating as you get into the end of its life. So the last 30 days or so, and you can see from this chart, it actually drops off to zero on the end, on the right-hand side. The price of the options are going down very rapidly. So we're going to be using that in this particular trade. Now, you've got the basics. Those are the things that I want to have in your head as we discuss the trade itself. And let's actually look at the trade. Why are we trading iron condors, and what are they useful for? Well, one of the things that really got me intrigued about the options market as I kind of grew in my career was the fact that you can do trades with options that you just cannot do with anything else. When you buy a stock or sell a stock, the stock basically has to move for you to make money. You're waiting for the stock to move. And if it doesn't move, you're sitting there twiddling your thumbs. If it moves against the direction you believe it's going to go in, you're losing money. Options gives you the ability to make money even if stocks don't move. So this is a tool that I use when I find a symbol that I expect to stay in a nice, tight, specific range of prices. It's going sideways, not going up, not going down. Maybe it's going to waffling around a little bit, but it's basically just locked in a range. I'm also looking at it from an options point of view. I'm looking for opportunities with relatively high implied volatility, not outrageous, but just reasonably high, and good premium to capture profits. Iron condors, when I'm building them, give me specific limits to our risks, which is a great thing to have in a trade. You know, I am not creating an unlimited risk trade. I can very clearly define what my max risk is, and then with a little bit of work, I can actually manage it to a much smaller risk. And here's the key of why I actually use these a lot. We're taking advantage of options' natural tendency to be overpriced in implied volatility. The trade that we're going to construct actually puts us on the same side as the sellers of the options, the guys who are pretty much driving where the prices are. The same people who are, you know, basically trying to get a higher price on the options so that they can get a profit and make money on the trade. So we're joining them in the process of them making a profit. The last piece is, depending on how you design an iron condor, they can be designed as high probability and consistent trades. You know, a long time ago, I gave up absolutely crazy trading. It's just, you know, that super fast in and out, you know, open, close. It wasn't that I wasn't profitable doing it. It was I was getting stressed out by doing it. It was not a happy existence. You know, I was moving around money in a massive way, and you know, any one moment things could blow up and I could lose. As a matter of fact, I mean, to brag a little bit, back in 2007, our systems that I was managing for my company were trading about $500 million a day in high-speed trades. At one point, we peaked out, and our volume was 15% of the SPYs on that day. Our trades were literally 15% of the total number of trades on the SPYs for that day. So we were moving around a lot of stuff. Honestly, I'm over it. I just don't want to deal with that stuff anymore. And I think for a normal trader, a more controlled, manageable trade is a smart thing. You know, I would rather you put on some good trades than go out to the golf course and enjoy your life while the trade's working for you than having to stare at a computer screen every minute of every day. It's just not a good life. It's not even healthy. So let's take a look. Here is the basic concepts of an iron condor. I'm selling a call option. My general rule of thumb, and for those of you who are options traders, you'll understand what I'm saying here, is that I sell it out of the money call option at roughly a 15 delta. Now, 15 delta is one of the Greeks. It describes how the price of the option moves compared to the price of the stock, but it also is an indication of what the chance that the option is going to be in the money at expiration is. So 15 delta can also be read as only having a 15% chance that the stock is going to move all the way up through that call strike and be in the money at the expiration of that option. That means I got about an 85% chance of that not happening, which is good. So I've got my short call. I've sold a call. I go out a little bit further, usually about $2 these days, and I buy a long call option. Because a short call, a naked call all by itself, is a very, very risky trade. If for some reason the stock shoots up, I am exposed to a lot of risk. And I don't want to be in that situation. I don't want to take a risk that I can't control. So by buying a long call option, it limits my risk to just the difference between those two strikes. Now, it costs me a little bit to buy the long call, but I've made more by selling the short call. And the difference between those is the credit I receive on the trade. Now, the nice thing is my risk is now limited to the difference between the two strikes, let's say $2, minus the credit I receive, let's just say 25 cents. And I am going to have a trade at that point, it's got about an 85% chance, based on the implied volatility, that it's going to be successful. Now, remember a few minutes ago I said that implied volatility is normally pushed up higher by people who want to have a profit margin in their trades. So what's really happening is the implied volatility is higher and our risks are actually overstated in that particular delta. We've actually got a better than 85% chance of being successful. Now, I flip around and, first of all, the margin on this trade is the difference between the two strikes minus my credit I received. So 25 cents, $2 minus 25 cents is $1.75. Since they're options, I got to multiply that times 100, $175 in margin for one of these essentially bear call positions right now. I flip over to the other side and I start working on the puts. Once again, I'm looking for a 15 delta, trying to match up pretty much with what I did in the calls, and I'm going to be going down this time. I'm going to be selling a short put at roughly a 15 delta, and then buying a long put another $2 lower. Once again, I'm setting up the same spread trade. Now, here's the cool thing about this. I received, well, let's say I received 20 cents in credit on the call, the bear call side, the short call plus the long call, netted me about 20 cents. And that meant that I had $1.80 worth of risk on that side. The other side I put on, I net myself another 20 cents. So now I've got a total of 40 cents, but I don't actually double my risk. What happens is the brokerage knows that I can only lose in one direction or the other. I can only lose a maximum of that $2 spread. So now I have 40 cents in credit against $2 in risk, reducing my overall max risk down to $1.60, and I've got 40 cents worth of return on a potential trade. Depending on the time frame you're dealing with, that's a pretty decent little trade. So, how do we find good targets for this? Because ideally what we want to do is find a symbol that is not doing a lot of price movement, or at least compared to its implied volatility isn't, and we want to have a good chance of making a high amount of credit versus the actual risk that we're taking. So when you break this trade down, what you're doing is you're being paid to take a risk that a stock is going to stay within a certain range. And what really determines whether or not that stock stays within that range? Well, most of you probably have some understanding of technical indicators, and those are wonderful things to use. Bollinger Bands, average true range, all of these are great tools. Moving averages. I was listening earlier, and we've got some really great insights on price movement. Use all of that stuff. Understand it. But there's another basic way to look at this that I like a lot, and that's historical volatility. Now, implied volatility is a number, like 22%. I think that what I'm seeing on the screen right now is 22.5% implied volatility on IWM, which is the ETF on the Russell 2000. That is saying that over the next 1 year period, a 1 standard deviation range based on the risk implied by the price of the option is going to be 22% up and 22% down. So that tells us right now what the market in the options are pricing in for risk and are pricing in for price movement. The next piece, though, is something called historical volatility. Historical volatility is a measurement. It's measuring the speed or the rate at which the stock is moving around. And it's there's a bunch of different formulas. I use one called the Rogers and Satchel formula for historical volatility. Most brokerages use what's called a log normal standard deviation. But if you've got an options trading platform, you will be able to get a historical volatility measurement. What does the historical volatility measurement tell us that's different from the implied volatility? Well, it tells us what the risk is, or what the range of price movement, or 1 standard deviation range of price movement is in the future based on how the stock actually has been moving, which is important, because what better to tell me about what is likely to happen in the near future than what has been happening in the recent past? I like to think of it in 3 different terms. implied volatility, historical volatility, and forecast volatility. And the forecast volatility is a little bit different. Let me go through these in terms of an analogy that might help you think about them. Historical volatility is measuring the speed of a car going down the road. You know it passed point 1, and you know it passed point 2, and you know the time it took to get there, and I can calculate the speed that that car is going down the road. Pretty straightforward. I can break it up and I can get a little bit more accurate if I want to do more samples, but basically it's actually measuring what happened. So forecast volatility is taking that measurement of how fast that car went down the road over that period of time and looking into the future and having a little bit of an insight as to what the road looks like ahead. And I know that this car is going 55 miles an hour and the road ahead is going to be a little bit rougher. Well, I just adjust the speed of the car a little bit to accommodate the fact that the road ahead's rougher. Or maybe it's going to be a smoother road ahead. I don't know. But I look to the future and I see what is going to change the way that that car is driving, the speed. I modify it slightly to accommodate the future conditions, and that's my forecast volatility. So now I have two numbers to work with, historical and forecast. The third number is implied volatility, and that's given to you. And implied volatility, another way to look at it is figuring out how fast the car is going down the road by what the owner of the car is getting charged for their insurance rates. Now, it seems a little absurd, because it is, but it actually is a fairly decent analogy for the options market. You're assuming that because they get charged a high insurance premium, they're a faster driver. And that's essentially what implied volatility is on options. Now, insurance companies, just like options writers, have every incentive in the world to get as much profit out of the customer as possible, up to the point where they don't get customers anymore. So that's what we want to start comparing. If we're being paid on an iron condor to take a risk, I want to be paid for a higher risk than what's actually there. And if I'm looking at this little chart right here, this IWM chart, I am seeing an implied volatility of 22.5%. and an actual historical volatility, and I know the number is a little tough to read there, but it's about 16%. So I'm getting paid to take a risk at 22.5% when the stock itself is actually only moving at about 16%. That's actually a pretty good way of taking a look at the trade. I love to see those situations. On top of this, I've got a nice, relatively easy channel sideways. IWM really has not been going anywhere. There's a lot of small caps, and they've just been languishing lately. Good sideways channel, and we have a good opportunity to be, to make a decent trade. A couple of things we need to make sure of is no risky events coming up, and if the implied volatility and historical volatility difference is too extreme, then we want to find out why. So a couple basic things there. All right, I've already talked about this part. So we're talking about entering the delta around 15. This is a good place to start. I typically use an iron condor that expires about 20 to 40 days out in the future. There's actually some great trades you can make that change that. Some people like to be very aggressive and do short-term, even weekly iron condors. You can make some really high profits off of that, but you're exposed to very, very short-term price movement risk in the market. The one that I love, and especially these days when we've got a bit of a chaotic market conditions out there, is going out very far. This allows me to take strikes that are very, very far away from the current market price and have an extremely high probability of success, and I don't have to worry about quick little market movements going back and forth. Now, I'm going to jump out of this and dive into a spreadsheet that I brought and walk through setting up an iron condor. And I've got the spreadsheet. With my people at T3 Live, and we're going to give you an email address. You can just say, I'm interested in getting the iron condor spreadsheet from Doug, and we'll give you a copy of that. So no strings attached. I'm not asking you to sign up for anything. I'm not asking you to put a credit card down. No money. This is a freebie from me to you. This is a tool that I use all the time for iron condors. So let's dig into that one for a second. And tell you what, Reed, if you could do me a favor, I sent you over an email address. If you could send that out to everybody and just post that so everybody can get what I'm talking about, I appreciate that. Okay, let me do two things here. Let's walk through this. I'm going to give you the setup that I'm seeing right now. We have IWM. It's Russell 2000. Nice broad-based ETF. We've got 2,000 different symbols in this thing. A couple of things that I like about that. There is no risk related to one specific stock. I mean, I'm not going to have somebody have an earnings announcement and have this thing go crazy on me. I'm not going to have a lawsuit cause the IWM or the Russell 2000 to crash down 15% in 2 hours. It's stable. It's controllable. I like it. It's something I'm looking for. On top of that, and I kind of did my research before I came in. On top of that, I have an implied volatility that is relatively high, 22.5%. That's what I'm looking at on average on these options in the market right now. And once again, the red line, which is down below here, is my historical volatility. That has a historical volatility, a measured movement of the stock in the market of 16.6%. That's by taking samples basically close to close, figuring out how much this is changing on a daily basis and extrapolating it into the future. So I'm going to get paid to take a risk of 22.5%, but the real risk in the market is closer to about 16.5%. Very, very nice setup. A couple other things that I like about this is that over the life of the IWM options, they've almost always been high relative to the historical volatility. It gives me some confidence that it's going to stay that way. Very few moments in time have implied volatility gotten significantly higher than the implied volatility, or historical been higher than implied. Good things to know. Now, I'm going to jump over and basically construct my trade. In this particular case, I'm using a relatively short-term iron condor. I'm going to use the February 20th monthlies. The further out in time we get, the wider the strikes that we're going to use on the same delta, the wider the strikes will be. And I'll show you that in a second. So in this case, I used 15 delta. I came out with, hold on, with a call at 122, oops, hold on here. Okay, prices have shifted around a little bit since I started this. So 122.50 is the current strike that I would be using. I'm going to go out $2. Now, quick little note on spreads. First of all, on the call side and the put side, you do want to have the spread the same. If it's $2 on one, have it $2 on the other. $5 on one, have it $5 on the other. Now, there's an incentive to try to get, let me see here, 22.50. There's an incentive to try to get the spreads just as tight as possible. If I could make this 50 cents, I would. But the reason for that is that the amount of credit that you receive for the trade goes up relative to the risk you're taking faster on tighter spreads. You're leveraging your trade up. You get more and more return for the amount of risk that you're taking. But there's a problem there. When you get those too tight, your commissions, which stays the same no matter how wide or tight the spreads are, your commissions go up to a point where it wipes out the gains you're getting from having tighter and tighter spreads. General rule of thumb right now, if you've got about $1 to average of $1.25 per contract cost, brokerage cost on your trades, usually a $2 spread is just about where you want to be. It gives you your most bang for the buck before you start losing out because your commissions are too big a percentage of the credit you're receiving. So just a little quick practical note there. So I'm taking my call spread, 122.50. I'm going short on that. 124.50, I'm going long on it. On the put side, let me double check these. And I did that by basically coming down my delta column until I found the delta that was the closest to 15. In this case, it's a little less. I might have got aggressive. I might have gone a little bit higher. It depends on your personality. You can go even much higher if you want. You'll make more as a percentage return on the trade, but you're going to have a tighter strike, and it's going to have a higher probability of losing. What it really means is that you're being paid more to manage the trade more actively. If you're good at that, you can make more money. If you're not good at it, it's going to be a painful process for you. I find a delta of around 15 is a pretty good compromise. I don't have to manage these trades very much. There's a pretty high probability of success. Now, flip side, the puts. I'm just going for a similar delta. In this case, right here, 109.50. All right, I'm going to change my strike. And there. So I now have my iron condor. I've got this thing is set up with a 122.50 short strike on the call, 124.50 long strike on the call. By the way, these are all with February 20th expirations. I've got a 109.50 short strike on the put, 107.50 short long strike on the put, giving me a structure that looks about like this. Now, as long as I stay between 122, oh, I got to keep this thing moving. As long as I stay between 122.50 and 109.50, I make 42 cents. My margin cost on this thing is about $1.58. I actually make a pretty darn good profit on this. Now, let's take these numbers, transpose them into the spreadsheet, and let me walk through the spreadsheet, let you know what you've got here, and I'm going to have to get going because I just got to let know that my time is coming to an end. All right, I'm going to shorten this up. The spreadsheet that you can get, and Reed, did you have a chance to send that email out? Because just send our customer service department at T3 Live. Excellent, thank you very much. Send T3 Live that email, and I'm going to have this in their hands, and they're going to be able to forward that to you. So when you're working with a spreadsheet, the yellow boxes are where you enter in information. IWM is the symbol. Our forecast volatility in this case was 16.5%. I literally just took that from the historical volatility over here. The blue cells are all calculated for you. Current price is 117.25. I'm going to say I'm going to take 20 of these. The expiration date on my options is 2/20. Now I'm just going to fill in the details. So hold on here. 124.50, 122.50. These are the strikes: the short call, the long put, and the short put. Now, prices: 14 cents, 39 cents, 60 cents, and 42 cents. Okay. We're going to wrap this up. Sorry to make this so quick. I normally have a lot more time. But let me tell you what you're looking at now. Once you've entered this into the spreadsheet, it's going to do a bunch of calculations for you. I'm a huge math geek. I used to be quant analyst, so I know my probabilities pretty well. So I built in what's called a log normal probability distribution, and I figured out what's your chance of success on this thing. The spreadsheet, based on all of your entries, will calculate out your net credit, your total dollar net credit, your max risk, all of those things. How much margin this is going to cost. What are you going to win if you do make the max win? What is the return percentage? In this case, 27% over 17 trading days. And what's the probability that you're going to do that? So based on your forecast volatility, it calculates out what are your odds of actually being successful. So I have a 79% chance of this trade, if my forecast volatility is correct, of being successful. It tells me my break-even high, my break-even low, and the percentage chance I'm going to be within those at the expiration of the trade. Now, here's the piece that I like a lot, expectancy. Some of you have probably heard of expectancy before. Basically what it says is if I were to take this trade over and over and over again, statistically, on average, I'd win some and lose some, and based on the probabilities of the success of this trade, I would be making on average 7.53%, or 0.44% per day. This is a number I pay attention to a lot. Now, hopefully if they invite me back, maybe I can dig into this stuff a little bit more, but maybe this is, maybe this is kind of piqued your interest a little bit, see how this tool works. As I said, handing out the spreadsheet, you can have a free copy. Happy to have people use it. Do me a favor, please, please don't use it commercially, turn this into a product someplace. I do like to get credit for my own work, but other than that, it's yours. I don't think I'm going to have much time to answer a lot of questions. I'm sorry about that, but we've had a limited amount of time here today.